Good morning.
Good morning.
Good
How are you
morning,
doing?
Professor.
Yeah, good morning. Hi. Good morning, Anna. Good morning, Isetu.
Good
Good morning,
morning.
everyone else. Good morning, Jenith. How are you? Let's see. Looks like I have six people. Six people. Let's see. Yeah, six. Um, Let me also briefly check how many people are in today's discussion board. Okay, just to make. So it's best that, the numbers match. If the numbers match, that's what should be, that's what is. Oh, what am I doing? Yeah, here. Discussion board. Yeah, today. Alrighty, so let's see. So I have nine people. And so if I have also nine people here, then, well, I still have only six people. Three are missing still. Well, hopefully, let's just hope that they will be joining very soon. Um, so now, in our last class, we basically, got the concept. We did, but the concepts of four types of um, capital budgeting techniques, uh, which are basically, um, payback, payback time, which is, a very crude method, and we generally don't use it. And then there is, net present value, and then there is, internal rate of return, and then we have profitability ratio. And basically, they are all, three methods, at least, except the first one, which was, payback time. Except that, all the other three methods are basically, close related. Uh, and we also, important point, I also, uh, made emphasis on the fact that NPV is NPV has the final say when, NPV and internal rate of return point to different conclusions. Then NPV always has the final say. Now, next question is, how do we compare projects that have different lives? Okay. I mean, so far we have been assuming that the projects are either just standalone or mutually exclusive or competing. But, when they are competing, um, we have assumed that they have the same project life. But in reality, that may not be the case. Most often, the reality would pose two projects with different lives. So, okay, if there is a significant difference between mutually exclusive projects' lives, a direct comparison is meaningless, right? The problem arises due to the NPV method. Low net present value, of course, the longer lived projects almost always have higher net present values, right? That only makes sense because, there will be more future cash inflows, right? The longer projects, longer lived projects have more future cash inflows. So obviously the net present value will be greater. So then, how do you, so it's not Apple comparison between Apple and Apple, right? it's a comparison between apples and oranges. So what do? I mean, we cannot directly compare apples with oranges. So what we need to do is to we need to have a way of making, these differences, making these differences, or equalize these differences, right? So there are largely two methods, right? Two solutions. One is replacement chain method, replacement chain. The other one is equivalent annuity method, equivalent annuity. So if you use replacement chain method, it's basically, it extends the projects until a common time horizon is reached. Extend the project. So in other words, it's like a common denominator, okay? Or largest common multiplier, largest common multiplier. For example, if mutually exclusive projects A and B, and A has a project life of 3 years, B has the life of 5 years, then what do? We will then the common multiplier between the two is 15. So then we replicate the project for up to 15 years. That means we will need we will replicate this 3-year projects 5 times, right? And this 5-year projects 3 times, and see which one ends up with bigger NPV, right? That makes sense. And then the equivalent annual annuity method, equivalent annual annuity method, replaces each project with an equivalent annuity. It says perpetuity. But perpetuity is an annuity without end. But so basically it is annuity that equates to the project's original net present value. Okay, so we have 2 projects, and we have, both of the projects have net present value. And with that net present value, we try to find out which projects, so project A has net present value of something, project B has net present value of something else. And then, obviously, because the lives are different, we cannot directly compare these net present values. But then, what kind of annuity payments will this give us? Right? What kind of annuity? So we have net present value. To get that net present value, right? What kind of annuity? That kind of net present value. What kind of annuity payments will it give us? And whichever gives us higher annuity payment is the winner, right? Makes sense. The logic is very straightforward and clear. So let's take a look at the first example, which is replacement chain. Which of the 2 following mutually exclusive projects should a firm purchase? The first one, second one. The first one is short-lived project, net present value of 432, at an 8% discount rate, right? And IRR, internal rate of return, is 23.4. So short-lived project has the time initial investment of this, and the cash flows are like over 3 years, 750. Long-lived project has net present value of 867, both at the same 8% discount rate and internal rate of 18.3. Now this is mind-boggling, isn't that right? Because if you look at net present value only, right, then the longer lived project certainly wins out. And I told you, it's longer-lived projects are bound to win out because they always certainly do give you more future cash flow. So for a longer period, so the net present value will be greater. But looking at the internal rate of return, it's got lower internal rate of return. So then, what do we do? And you might remember, you might remember me saying that when net present value and internal rate of return are different, go for the net present. But then, this is not the case. Why? Because you go by that rule if the two projects have the same project lives. If the two projects have the same project lives, but in this case, the two projects have different project lives. You can't really go by that. So then, what do you do? So we'll compare this with both, replacement chain method and equivalent annual annuity method, right? And both methods will lead to the same decision. So first, the replacement chain method. So of course, this is, basically we put these two projects on the timeline, and we know, right? And you might wonder why only the first 2 years are highlighted. Why is only? I mean, if they were to highlight it, why don't they highlight all 3 years? Now there's a reason. We are replicating, right? In other words, we will have to replicate these projects for up to 15 years. Remember that replacement chain methods require the largest LCM, largest common multiplier. In other words, between 3 and 5 is 15. So these projects will be, excuse me, these projects will be, the first project will be replicated 5 times. That meaning this is time 0 in the first set, the original life. And if we replicate it for the second time, time 0 of the second life will start at C3. In other words, there will be at C3 you have cash inflow of 750, but also there will be cash outflow because you're replicating the project. Another outflow of 1,500 there at C3, and then 750, 750, 750. Then third replication, right? We'll keep going like that. Longer lived projects, it will be replicated at this point. Another $2,600 will be invested, right? Because that's time 0 of the second life. There will be cash outflow, and then 750, 750, second, another 5, right, for 5 years, and then another replication, and so on. So look, this is a 3-year project chained into 6 years, right? So yeah, second chain, second part of the chain, right? So here, if with 2 Was it 6 years or 5 years? Second one has 1, 2, 3. Oh, it was 6 years. 1, 2, 3, 4, 5, 6. Oh, this is 6 years. Okay, that's fine. We don't have to replicate it. The original setting, I believe it was 6 years. Okay, so we only need to replicate it this short-lived projects twice. We only need to and because then both projects have 6-year timeline. I thought the second one was 5 years. Then it will be 15 years. We'll have to replicate it for 15 years. But now, so if we replicate the first project twice, then our net present value will be 776. And compared with the second one, second one still wins out, right? Now they both have 6-year timeline, and the so now they have both 6-year lives. And then now the lives are the same, project lives are the same, and then NPV of the second project, longer-lived project, is greater. NPV of the greater, right? But the internal rate of return of the first project is higher. Then what do? I told you, you go for the when the project lives are the same and mutually exclusive, then you go for the greater NPV. Go for the greater NPV. Okay. So then the second project will be picked. Okay. Now, of course, we're going to do the Excel exercise. The second one is, equivalent annual annuity method. Equates each project's original NPV to an equivalent annual annuity. For the short-lived project, the equivalent so wonder if it is if it is referring to the same. Yeah, the same example. So the NPV of the shorter-lived project originally was 432. I don't know why I just left it like this. Probably. Okay. I'm gonna have to. I'm gonna revise this later. The original PowerPoint. Then with that net present value, right? So this is the if you were to have net present value of 432, it should be an annuity should pay an annuity plan. If you are buying an annuity should pay you, if you pay $432 for that annuity should pay you something like $167 at the end of every year, right? Such an annuity's present value will be equivalent to 432. Okay, so this is the annual annuity amount. Okay, while the long-lived project has an equivalent annuity of 187.5. So look, longer-lived projects present value was 867, right? So then that means, with this 867 as the present value, what kind of annuity payment will be uh, equivalent? What kind of annuity payment will give you this this present value? Uh, and to solve for that annuity payment, 187. So then the second project wins out, right? So this is, they both, both methods are pointing to the same conclusion. Now, you don't, we need to vet it. We need to vet it, right? We need to verify how. We need to, we'll do that by Excel. But, just for today, let's take a break at this at 10 o'clock. I mean, between 10 and 10:30. I need a 30-minute break today because I must, apologize. But, I have to pick up my, remember my computer crashed, the original computer crashed, and I got it finally fixed, no data recovery. The repair guy looked into it, and, it was a disaster. There was no data. All the data are gone. So I had to completely reinstall Windows. So it was rather an easy job for the repair guy. But too bad for me, I lost all the data that I had on it. Of course, I have some partially backed up in the cloud and in the external hard drive. So not everything is lost, but the ones that I haven't backed up, and those are the ones that I commonly use, they're all gone. But I have to pick it up now. It was just the time window. I mean, that guy is, it's Saturday, and that guy is only open, during certain window. So I must excuse myself. So it will take about 30 minutes. So let's take a 30-minute break, okay, and reconvene at 10:30. All right?
Okay, Professor.
All righty. So I'm gonna. Can someone drop something in the chat box about this 30-minute break so that everyone can see? I don't have time to write it up in the chat box. So if you would, drop something in the chat box, I would really appreciate it. Okay.
You're
Thank
starting
you.
right
Thank
now,
you.
Professor?
Yeah. The
Okay,
break starts right
I'll
now.
write in the chat box.
Reconvening at 10:30. Thank you. All right, I'm back. I'm back. I hope everyone is back too. It's almost like a 30 minutes in a what do you call that? Blitzkrieg, which is Blitzkrieg is what the German German army, German military tactic during World War II, which is, like swift attack, swift, swift attack, swift get out, in English slang or English vernacular expression, bada bing, bada boom, right? Bada bing, bada boom type of thing. So what does the equivalent annual annuity, what does that look like? Equivalent annual annuity. And this is something, no, this is still, okay, the first, in this picture, in this diagram, first link, second link is more like the picture of replacement chain, right? But the second one is down here, EAA, is simply showing you what is the payment of, what is the annuity payment, right, of a $432 present value. So without further ado, I think it's the best to do Excel example. So I want you to open this file. This file we've been working on, we've been using it since last time, right? The file named Corporate Finance Examples, right? In the so please open that, and which is in okay, here. And if you downloaded it last time, you have it there. If you downloaded it last time, you have it in your computer. The first thing is this is a PDF file, and this is the Excel file. And you must have it on your computer. Have it, so please open it in front of you. Have it in front of you. And you must find this bottom tab, which says EAA. Okay. So maybe I should have moved this. It doesn't look natural. So do you have it all in front of you? Do you have it all in front of you? Hmm?
I'm opening it up now.
Just opening only now, huh? I said open it like 2 minutes ago. So I'll give you just 30 seconds, right? I want you to have it all in front of you.
You got it open.
Professor, quick question.
Yeah, someone had a question?
Yeah. I was gonna after the test this week, the test this weekend is our last test until the finals.
Yeah, right. I mean, this is quiz 2. So this is the third exam. The last one is final.
Yeah. Okay.
So obviously the final cannot be given yet. It's not final should be, at the end of the semester, right? So this is the yeah,
Okay.
one
Do you
last
have a date
exam
for our
before.
final or not as yet?
I'm sorry, I
Do you have
missed
a
you.
date picked out for final?
Yeah, it will be like, because our last day of class is come on, my mouse where's my cursors? Ah, okay. Our last day of class is December 11th. So it will be in the week of this on the Friday of, I mean, between Friday December 10th and Sunday the 12th. Okay, normally if this is a class meeting during the weekdays, either we can have either Monday or Tuesday as the for the final, right? Monday or Tuesday, like 13th and 14th. But since this is meeting only on Saturday, we cannot wait until, right, 18th or 17th. So we're gonna have it on the 10th through 12th. Okay. Alrighty. So you have this
Okay.
file. Alrighty. You're welcome. You have this file in front of you, everyone. So the file
Yes.
yeah, okay. I just rearranged a couple of things. First of all, what you see in front of you may not look exactly like this. The labels, I brought the labels down. It was previously, so you can insert a row there, and then, that way all uh, the time will be consistent. All the time will look consistent. At first I had like, payment 0 or something like that. But, this column is the for time 0, time. So I think, making it uniformly, consistently uniform, right? Making it consistently uniform is very important. Time. And then cost of capital or discount rate uh, should be just in this row 2. And then, column B is cash flow, and column C is the present value of the cash flow. So I, just kind of, revised it a little to make it look uniformly, consistently uniform. Okay. Now, first of all, we all know these are, the cash flows. Always at time 0, it's initial investment, and it's already, it is always itself. It's always already in present value, so you don't need to do anything. Or if you want to do, you can do this. I can just, first year, right? In the first year, present value, right? And even if you copy and drag it up, right? It still has, a uniform structure, structurally uniform, right? Everything is structurally uniform, and then still, it's the present value, right? Because anyway, raising something to 0 is still, always 1. And then so when you find the present values and find the net present value, right? Sum of all of that, yeah, that's net present. And then internal rate of return. This is internal rate of return. The reason you might find it weird, shouldn't the label be above? Yeah, that's what I would have done, but somehow, okay, to do that, I would have to. I think it is better to do it that way, moving the label somewhere there. But then, if you do it this way, the thing is, and if there's year 7, right? Then year 7, I will have to no matter where the well, if I have 7, 8, 9, 10, I just need to add insert rows, more rows. But without having extra rows, if I have these labels in this row, it would make it more compact. But I think it doesn't look that natural if I have the label below the solution. So let's say. So I would rather, maybe this is better the way it is now. Maybe this is better. Let me just put it in a lower, big, thick border, right? This way, you can have. All right. So we can find internal rate of return by using IRR command, and the net present value. I just did that, and we have conflicting results, right? And net present value of the longer-lived projects are always greater, but the internal rate of return of short-lived project is better, and you can't, say we go for this because they don't have the same project life. But then if we use annuity, equivalent annuity method, right? So, and some of you, this is Finance 100 thing, right? Finance 100. I don't want to do this, but let me open. You must have all learned, time value of money in Finance 100, and in one of the and in time value of money, there are two types of cash flows. One is, single cash flow. The other one is multiple cash flow model. Multiple cash flow model. A typical example of multiple cash flow model is annuity. And if you remember, there's present value of annuity and future value of annuity. So in both cases, let me. Oh, no. So let me just remind you. Let me copy what's going on. mouse. Mouse is dead. Okay. Why isn't it working? All right. I just I'll just have to. And then okay, so I guess I got it all. So now we have future value of annuity and present value of annuity, right? And this is a, I don't want to re-explain everything all over again, because this is something you should already know. Annuity payments are always in the future. That doesn't make all the annuity problems future value of annuities. Because in finance, cash flows are always in the future, right? And the cash flows that were already in the past are irrelevant because it doesn't affect our level of wealth today, right? Because if you're buying in finance, basically you're buying an asset that will generate cash flow in the future, right? So all finance problems basically, deal with the cash flows in the future, right? Starting from time zero, right? Remember, even in this in these examples, right? All these projects start from timeline, time zero in the timeline, and the timeline basically cash flow at time zero is always already in present value, and everything is in the future. All the cash flows, the rest of them, cash flow 1, 2, 3, 4, 5, cash flow n, they're all in the future. Now, and the annuity is a cash flow that is, in a regular amount at regular interval. Okay. So how do I? Let me see if I. It would help if it helps understanding. Oh, what happened? Okay. I hate to go back to our Finance 100 materials, but which you should already know. But, to help. So the case of, and this is the case of future value of annuity, right? Look, cash flows are all in the future, right? And in case of ordinary annuity, there is no cash flow at time zero because these annuities always start at the end of each time period, right? Whereas in case of annuity due, you have cash flows starting from day time 0, right? Now, so look, cash flows are always in the future, and finding what would be the future value of all of those annuities, right? As that will be earning interest, right? Every period, right? So it's basically compounding, right? Each of the annuity payments or deposits will earn interest for the remaining time to maturity, right? And that's the future value of annuity. And then in present value of annuity, also, look, cash flows are always in the future, right? Only, and then the question is, what is the present value of all of those future cash flows? That's present value of annuities. Now, this problem is exactly present value of annuity problem, right? And remember, future value of annuity, if you solve that for payment, in this, finding future value of annuity means, we know what's payment. We know future value of annuity is the only unknown, and the other variables are known, right? Payment, R, and N are known. But if you solve this for payment, if payment is the unknown, we simply need to flip it. In other words, this is like Z equals X times Y structure, right? So to find, X, right? You see my cursor, you can see my cursor moving, right? Some people ask me, so what are you pointing at? Professor, I can't see what you're talking about. What are you pointing at? I hope you can see my cursor. The cursor is moving, right? You can see my cursor, right?
Yeah, I see
Yeah,
it. It's
we
on
can
the
see
top
it.
panel.
Yeah.
It's there.
Okay, great. So, because still on this computer, I cannot write anything. I cannot even draw. So please bear with me. So this is like Z, right? Future value of annuity is like Z. Payment is like X. The rest of them, 1 plus R raised to N minus 1 over R, that's like Y. And I've been telling you over and over, no matter how complex any equation may seem, right? The key to solving any equation is identifying the Z equals X times structure, right? If Z equals X times Y, then X is Z over Y. Y is Z over X. And we have identified that structure. This is Z, this is X, the rest of them is Y. So if it's like 12 equals 3 times 4, if 3 is the unknown, what do you do? 12 divided by 4. 4 is the unknown, what do you do? 12 divided by 3. So if payment is the unknown, you basically divide this by this. And dividing something by a fraction is the same thing as multiplying by the reciprocal of the fraction. So multiplying the reciprocal. But that's the future value of annuity case. Present value of annuity, the formula is like this. This is the formula for present value of annuities. And if you solve this equation for payment, factoring out payment from this formula, and then you can once again put it into Z equals X times Y structure, and then if that's the case, then we solve. If payment is the unknown, payment is Z divided by Y. So Z divided by. Now, and I told you this is the present value of annuity problem, meaning actually it's the payment. It's the present value of annuity problem, but finding payment. So it is this. It is this. Okay? So then you might wonder. In other words, if this is, we found the present value, right? If this is the present value, right? This type of present value is the result of what kind of annuity payment? You understand? We're trying to find, okay, this is the present value. We found the present value, right? We have the present value already. Then this type of present value is the result of what kind of annuity cash flows, right? Annuities are equal payment at regular interval. So in other words, we are solving for this. And between the two projects, whichever gives me a better, greater payment, annuity payment, is the winner. Make sense? So therefore, we can use this, okay? And you might, oh, that looks complicated. But no, well, you just follow PVA, right? Times R times, R is the discount rate, so that's 10%, right? Then divided by, open parenthesis, I'm sorry, it's R times 1 plus R raised to N times 1 plus R raised to N. N is D, and this divided by, open parenthesis, open 1 plus 1 plus R raised to N minus 1 plus parenthesis, hit enter. Yeah, we got the same number. If it's just dollars, you just put $sign. We got the result, same result. Isn't that right? We got the same result. And this one, how did I do that? I just used the payment formula in Excel's built-in function, right? But before using Excel's built-in function, you got to know what is the formula for that, right? So let me at least get it bold and underline. Okay. Now the second one, second project, I'm gonna just replicate this. I'm gonna copy. But before copying, I will need to lock a couple of things. C13, D13, it can be left there. B2, if I copy it there, it will be yeah. And then A7, okay, it can be copied, I guess, without locking anything. Just change that to, I'm going to copy that, paste here. And then, okay, what's E13? No, that should be D13. No. What am I talking about? E13, D2, or minus D2, and C7, no, it should be A10, paste to A10. Because now it's 6-year project, right? So I have to discount it by 6. There you go. I got the same result, right? I got the same result. So, but I used here. I used Excel's payment formula, a payment pre-built function, right? So let me show you how I do Excel's pre-built function. So you go to function, right? And it's better to go into the financial category because the function that you are looking for, the command that you're looking for, is not in the most recently used. And by default, what comes up is the most recently used functions, right? So if it is not there, you better go to the financial. And what we're looking for is payment. Scroll down until you find payment. Hit OK. Give it what it's asking for. Rate is the discount rate, right? There you go. Number of periods. That's the number of periods, right? Present value. Here's the present value, right? But you should enter it as negative because then it will give you, and I've been telling you on a financial calculator setting, one thing has to be cash outflow and the other thing will be cash inflow, right? So if you want the payment to be the cash inflow, and that's actually what you want. I mean, the annuity payments are the future cash inflows, right? So to have annuity payments as positive number, you should enter this as negative number. Then here we go. Okay. So it's this. Oh, and then we do the same thing here. Go to function. You can copy C15 into E15. Then you will still need to make some adjustments because if you just copy it, then it will be it is always a relative location of the relative location of the cells, the data cells, right? Not the absolute location. So you would need to make adjustment. But anyway, so I go to I find payment. Give it the rate. There you go. N periods. This time it is 6, right? Present value. This is the present value, and you enter it as negative. This is cash outflow, and then we already have, right? Hit OK, and between the two, so we got it. Okay. Any questions so far? Any questions? Any questions?
No, I think it's pretty clear.
Okay, good. So then that wraps up everything. That wraps up everything about the where is okay. So this one I can close this now. So that wraps up everything about the capital budgeting. And the last topic in the capital budgeting is capital rationing. And capital rationing. I'm sorry, somebody has been just my text messages just buzzing so many times. So it's bothering me, breaking my concentration. Think about it. When we say budgeting, that means we have limited budget. We have limited budget, right? And when we have limited budget, we will have to ration it, right? First of all, so eventually, when we say capital budgeting, it will lead to capital rationing. I mean, if we have only one project, we don't need to worry about budgeting or rationing, because we just need to either approve or reject, right, by NPV or internal rate of return, right? And when we have competing projects, then it will be whichever, and if the competing projects can only, the reason they are mutually exclusive is because only one project can be accommodated with our budget, right? So we will need to pick which project has bigger NPV or higher internal rate of return. That's the decision criteria. But let's say we have $10 million budget, and we have multiple projects that are competing. Then we can accommodate, let's say we have 5-6 competing projects, and if all 5 projects fit our budget constraint, we can accommodate all of them. But again, we cannot accommodate a project that has lower than negative net present value. We cannot accommodate anything with negative net present value, or we cannot accommodate anything with internal rate of return that's less than cost of capital, right? Assuming that they all pass this criteria, assuming all 5 projects pass this criteria, then not all 5 projects can fit. Not all 5 projects can fit into the budget. Then we'll have to clearly eliminate. We'll have to prioritize them, right? And then fit it. We will accommodate as many projects that meet our criteria and fit within the budget, right? So it's like this. Suppose we have $16 million funds available, right? And our cost of capital is 10%. And we have how many competing projects? We have, 1, 2, 3, 4, 5, 6 competing projects. Not all of them can fit $16 million budget constraint, right? This is called budget constraint. And E and F already, disqualified, right? Isn't it right? E and F already disqualified because its internal rate of return is below our cost of capital. They are disqualified. We eliminate them. But then within the budget, I mean, C and A and B clearly pass our criteria, right? A and B. But then, we still have some, so $3 million, right? We still have $3 million left, right? We still have $3 million. Um, this thing is, covering it up so you can't see. But then project C, you see, it's 13 million down there. So project C cost 6 million. So project C cannot fit in there. But project C has higher internal rate of return. But what can you do? Project C cannot fit in there. So we'll have to, then project D cost only like 3 million or 2 million. It costs 3 million. Project D costs 3 million. So it fits our budget. It has, positive internal rate of return that is greater than our cost of capital. So then what do? We'll drop C and accommodate D. So we will carry out project A, B, and D. This is the essence of capital rationing. Okay, this is the essence of capital rationing. So is everyone okay with this? Is everyone good with this?
Yeah.
Okay, so that wraps up everything about the capital budgeting, and we're going to move on to the next topic, cost of capital. So cost of capital, okay? So before moving on to cost of capital, let's take a 10-minute break, okay? It's 11:12, so let's reconvene at 11:22, okay? Let's have a 10-minute break.
No, I'm taking it. I'm listening.
All right, we're back. We're back. Okay. Are you all there?
Yes, sir.
Here.
Yeah,
All
we're
right.
here.
Glad to hear you back. Glad to see you back. Oh, time passes, so flies like. So we're now moving on to cost of capital. And we know what cost of capital means. Cost of capital is the discount rate. But why is it called cost of capital? And this was also discussed in Finance 100, because that is literally a cost of raising capital. Cost of raising capital. Think about it. There are two types of capital, if you remember. Two types of capital, only two types of capital, either equity or debt. You remember that, right? You remember that. Only two types of capital. And then, so the company will have to fund their project or finance their project, right? A company will have to finance their projects through equity or debt. And to raise debt, you have to pay interest, isn't it right? To borrow money directly from the bank or through sale of bonds, you have to pay interest. So the interest is the cost of borrowing money, right? So it's a cost of specific cost of capital, but specifically there are three types of cost of capital, and interest rate is called cost of debt specifically, right? Cost of debt, and then next the company needs to raise equity capital through sale of stocks, right? So then stocks will not sell if the expected return is very low or zero or negative, right? You don't pay. So basically the required return, which is the discount rate for stock, right? Required return is the cost of equity capital, right? And then, of course, required return is not what the company pays directly to the investors, right? Company doesn't pay the required return directly to the stockholders, but instead, think about it. If the company does well, right? If the company does well, the profit will increase. The profit, which is EAT, right? Net profit, earnings after taxes, is basically the if you divide it by number of shares. Now, this is again, if you this is a question. If you divide EAT by number of shares, what is that called? Anyone?
The earnings per share.
Exactly. Who was that?
Anna.
Anna. Okay, Anna. So you get 0.25. Yes. If you divide EAT by number of shares, that's earnings per share. And think about it. Earnings per share is the return, right? Earnings per share is the return to your equity investment. Isn't that right? Let me write it. Let me use. Let me use the whiteboard. Okay, and then yeah, so EAT divided by number of shares outstanding. It's number of outstanding, right? But let me just truncate it as number of shares. That's just that's too long, right? That's called earnings per share. So this is the profit per share. So if I have only one share of this company, the earnings per share is exactly my return on investment, right? If I have 10 shares, of course I will have earnings per share times 10, right? But if you multiply it by total number of shares, of course then it's going to be EAT. And so this is the return on what? This is the return on the total equity, isn't that right? EAT, basically net profit, or EAT, is the return portion to the equity invested in this company. So this is called what? Anybody? EAT over equity, EAT divided by equity. This is called what? Anybody? Isn't that, I already even said that. What should this be called? Anyone?
Is it equity ratio?
No. Equity ratio is equity out of the total assets. That's the equity ratio. In other words, equity ratio is equity divided by total assets. Equity ratio is the counterpart to debt ratio. Debt ratio is debt over total assets. So equity ratio is, in other words, 1 minus debt ratio, right? But this is EAT, your net profit, right, over total equity. So this is called what? What is this called? Anyone?
Oh, is that return on equity?
Yes. Yes. This is what return on equity is. Right? This is return on equity. And so who was this? Was it Richard?
That's Richard.
Okay. So Richard, you get 0.25. That's return on equity. Think about it. And then as the company, but the return on equity is basically, the outcome and the result. Result is only something we know afterwards, isn't it right? The performance, result of the performance is something we can know only afterwards, right? But basically, investors are buying stocks because of their, expectations of return on equity. So they demand what they require, right, as return on equity is called cost of equity. Isn't it right? What they require, what they all, require as before the company releases its quarterly results, right? what the investors, stockholders, anticipate as return on equity is basically cost of equity. It's the required return. Does it make sense? It's the required return. So of course, required return is not exactly the same thing as return on equity, right? Because return on equity is ex post. In other words, it's something that we know after everything is done. But cost of equity, the required return is ex ante, right? These are all Latin words, ex post. This is ex ante. So this is something investors require as return on equity, right? So this is all based on expectations. Okay, next question is then, how can there be a unified, or how can there be a unified required return? Because how can you take how does every for example, for Apple or for Tesla, can you has every Tesla shareholder met together in one place at one time and all discussed and all agreed on one required return? No, not at all. Not at all. That's not possible. In the market, nobody knows who is. I mean, brokers will know, but nobody knows. Nobody knows who. Nobody knows who is Apple shareholder or Tesla shareholder. I only I sold my Tesla. I sold my Tesla shares, and then in the stock market, who owns which stock? Who owns which stock is all anonymous. I wouldn't know. And I sold my Tesla stock. Who knows? My broker may know.
I was gonna call you
Right.
paper hands.
I'm sorry.
I was just gonna call you paper hands.
Oh,
Never
you're
mind.
saying, yeah, it's just paper changing hands. Right? All right. And there was a background noise, so I'm not sure if you were talking to me or talking
No,
to
I was.
someone else.
It's just a joke that circulates online. If you sell an investment, they call you paper hands. If you hold on to it, they call you diamond hands.
Oh.
Just a joke. Went right over your head.
Yeah. Yeah. The point is, a stock market is anonymous. Any financial market is anonymous. So there is no way all the Tesla holders reach a consensus, right? About consensus about the required return. So this is so how do we know what's the required return? What's the anticipated or expected return? Or expected return is actually a different thing. It's the simply the average of the past returns. But required return, it's not a consensus of all the stockholders, but it is actually calculated through CAPM, right? Also in Finance 100, you should have learned what CAPM is. So it's basically risk adjusted Okay, I'm out of my the battery's gone. So give me a second. The battery is gone, so I have to replace the battery. So anyway, the point is, we have two types of cost of capital. One is can I write cost of debt, right? Which is the basically the interest that you have. It's not only interest; it's actually yield. But cost of debt. Let's just say it is interest you pay on the bond. Okay, it's quite clear. Okay, my mouse is on screen, so I'll have to give me a second. I'll just replace the battery in the. Oh. All right. What's going on? Okay, I guess my mouse is my mouse is down 4. I mean, I cannot. Mouse is working even after replacing battery, but that's fine. So I can't use the whiteboard anymore then. Now, so I said there are two types of capital. That's true. So far, we've assumed, two types of capital, either debt or equity. Now, from now on, we will break down the equity into two categories: common stock and preferred stock, because that's the reality. When we say stocks, stocks break down into stocks divide into common stock and preferred stock, and common stock is the main thing, right? Preferred stock sounds like it's better, but preferred stock is not necessarily better. I mean, it's only better in terms of regularity. In other words, it's less risky. Preferred stocks pay dividends before common stocks pay dividends. So in that sense, preferred stock is less risky, than common stock. But preferred stock doesn't, preferred stock pays fixed dividends, so the dividends are not fluctuating. Even if think about it, theoretically, dividend would go up if the EAT goes up. Dividend goes up if EAT goes up. Dividend would go down if EAT goes down. So in case of common stock, right? In case of common stock, your in other words, dividend depends on the earnings, right? The net profit. If the net profit goes up, dividend goes up. If it goes down, dividend goes down, and that's the case of common stock. And the residual is all, in other words, after paying dividends, right? And of course, before paying dividends is EAT. After paying dividends is retained earnings. But regardless, whether they pay dividends or not pay dividends, right? EAT belongs to you, right? The EAT, right? The profit belongs to the common stockholders. Okay. But of course, before that, from EAT, if the company has preferred stock, they will have to pay dividends to the preferred shareholders, preferred stockholders. So after paying out dividends to the preferred shareholders, then they pay out dividends to the common stockholders, but they don't, the company can decide not to pay dividends. I mean, they can hold paying dividends depending on the company's investment plan, right? If they have to, for example, in the last topic we talked about, there's $16 million available, right, to finance the projects. Where did that $16 million come from? Well, it could have come from three different sources. One, retained earnings. In other words, the profits that's retained, right, after paying dividends. But if the company wants to, if the company is investing in a strategic plan, strategic projects, right, then they will need to use all of the EAT, right, all of the profit to invest in the projects, right? Then they will hold out any dividend payment. So first source of the capital is the retained earnings, or EAT, right? I mean, if that 16 million is after paying out dividends, right? Second, it could have been, borrowed. Then, the company's debt increases, right? Also, the company's total assets increases as the debt increases, right? It could have come from sale of bonds, additional sale of bonds, or it could have been through sale of new equity, right? So either way, whether the company finances the project with new bonds, sale of new bonds, or whether they do it through the sale of new equity, both increases the total asset size, as well as, that means total debt also increased, or total equity increased, or some combination of the two. But then if you use the company's retained earnings, right? If it comes from the retained earnings, then the total asset size doesn't increase, right? Because you are using the retained earnings, which is, internally generated capital, internally generated, right? Generated through operating activity. But then think about it. The reason I'm talking about this, the reason I'm talking about it is, oh, the mouse is now working. Oh, okay. Somehow, oh, that was a crazy thing. Why wasn't it? So the point is, retained earnings comes after paying out dividends. The dividends can be first, it should be preferred dividend, right? Dividends to the preferred stockholders, and then second, dividends to the common stockholders. Even if you don't pay out any dividends to the common stockholders, right? You have to pay dividends to the preferred stockholders. Okay, because that's why. So the preferred stock is less risky than the common stock because there's regularity in dividend payment. Of course, the company can stop paying dividends regardless of common stock or preferred stock, right? That's possible. That's possible, right? If they need to muster up everything to invest in new projects, then they can stop paying dividends to even the preferred stockholders, right? But the priority is if they have a wiggle room, if they have a wiggle room to pay out dividends to preferred stockholders, yes, they will. But then that's it. They won't pay out dividends to common stockholders, right? So that's the only reason why preferred stock is less risky than the common stock. But otherwise, it's not necessarily better because the preferred stock doesn't get paid. Preferred stock doesn't have any. The dividend is fixed, so it won't go up, right? With the increased profit of the company. But the safety is, if the profit goes down, preferred stockholders, the dividend doesn't go down. It's fixed. But then, obviously, it's not that much. Dividend of the preferred stock isn't that much compared to a common stock. And then only common stock comes with the voting right? Because stock is the ownership in the company. If you're an owner, you should have voting right? It's one vote per share. There's sometimes there are like 10 votes per share. That's called Class A, B, Class A stock, Class B stock. Some companies have Class A, Class B stocks, and whether it is called Class A or Class B, it doesn't really matter. Sometimes Class A is the one that has sometimes Class B is the one that has like 10 votes per share. But obviously such a stock sells for much higher price. If you look into Google has Class A, Class B. Berkshire Hathaway also has Class A, Class B. So if Class A is the one with more voting rights, those stocks are only traded between the majority shareholders, right? Majority shareholders. Anyway, the point is, so preferred stock is not necessarily better. It doesn't come with any voting right, right? And it's only less risky than the common stock. So now we have broken down the equity, the capital into 3 categories. It's not really three categories. Oh. So total capital, I'm not calling it total asset, but I'm calling it total capital. Why? Remember, there's a difference between total assets and total capital. Total capital means only long-term capital, long-term capital. Capital means only long-term capital. In other words, if you remember balance sheet, right? The right-hand side of the balance sheet is liabilities and equity. And in the liabilities, it breaks down into a long-term debt and short-term debt. Short-term liabilities are not capital, okay? Short-term liabilities are not capital. Remember, short-term liabilities are not capital. Only long-term liability, long-term debt is capital, okay? So total capital breaks down into equity and debt. And equity breaks down into, this debt is long-term debt. Common stock. Common stock is called, this is what we call equity, right? We'll just call common stock equity, right? Because it has voting right. And then preferred stock. And the symbol for and cost of equity means cost of common stock, right? Which is the required return on the stock. And then preferred cost of capital to preferred stock will be called cost of preferred stock, KP, right? And then cost of debt, it will be called KD. All right, so those are the notations that we're going to be using. So project should not be undertaken the project should not be undertaken unless they return cost of funds invested in them. In other words, projects return must be greater than the cost of debt, cost of preferred stock, or cost of equity. But think about it. The return on the project is the result of the combined contribution of these combined assets, right? Combined capital components, debt, preferred stock, and equity, right? So we will think about it. If a company undertakes a project which cost $16 million, right? And this project is financed by a combination of debt, preferred stock, and equity, right? So then, how can you compare? I mean, how can you tell the return on this project, return on this investment, return on investment of this project is greater than every one of them, right? Greater than everyone. Sometimes, the return on that return on that project may be greater than cost of debt, but not greater than cost of equity, right? So, excuse me. And if it is greater than cost of equity, it will all pass. It will be greater than the rest of them, because the cost of equity is always greater. I mean, the order of the order is like this. The order is cost of equity greatest, cost of then preferred stock, and cost of debt. Cost of debt is the cheapest. Debt is the cheapest source of capital. So if it passes cost of equity, then it will pass all the rest. But then if you're using this, you cannot use this as the criteria. Why? Because as I said, the project is financed by $16 million, and this $16 million maybe it's some combination of equity, preferred stock, and debt. So then what should be the right appropriate level of cost of capital? So here comes the weighted average cost of capital. Weighted average cost of capital. Okay, so that's what I have. A firm's capital components are debt, common stock, preferred stock. The capital structure, and we know already what capital structure is, because we talked about this a lot at length in the earlier topics, like balance sheet and income statement, right? So the composition of our total capital is, again, this is total capital, not total assets, because we're only talking about the long-term capital. So the composition is, we have $100 million, total capital is $100 million. 30 million is debt, preferred stock 10 million, equity 16 million. So 30%, 10%, 60%, right? That's our capital structure. Mix of the three capital components expressed in percentage. And then we need to distinguish between target capital structure and the current existing capital structure. There is an optimal capital structure. Optimal capital structure. What is optimal capital structure? Optimal capital structure is the one that maximizes your earnings per share and maximizes your return on investment. That's optimal capital structure. You might wonder, what? So earnings per share may vary. Yes, of course. And you might think, oh, then because debt is costing us. I mean, that intuitively you might think, oh, so we need to increase our equity ratio and reduce the debt ratio. I mean, because debt, we have to pay interest. No, that's not correct. Optimal capital structure doesn't mean more equity and less debt. Okay. And I've been telling you from the earlier topics that the optimal capital structure is actually found somewhere around 70% equity, 60%, 70% equity, 60 to 70% equity, 60 to 70% equity, and 30 to 40% debt. Right? The optimal capital structure is found somewhere in between. It's not 100% equity that will be the optimal capital structure. No. Actually, if you have 100% equity, your earnings per share won't be maximized. Okay. So raising funding proportions of capital structure in cost of capital calculation. So lowercase, always the lowercase k is always the lowercase symbols represent rate or ratio, right? Rate. Cost of capital calculations, assume fund is raised in a constant proportion of debt, preferred, and common equity. Yeah. Usually either the current or a target capital structure. So if your current capital structure is like this, if this is your current capital structure, you will assume we will need, we will need $20 million. We need to raise $20 million to finance our project. So how do we raise capital? Exactly in this proportion. 60% of the 20 million we will raise in equity, 10% in preferred stock, 30% in debt, right? So we either use our current capital structure or target capital structure, right? And this is the idea being used despite being somewhat unrealistic. Yeah, it is unrealistic that we can raise capital exactly in that proportion, but we try to bring it close to our, this guideline, right? And usually target capital structure is the one. And the return on investment adjusted for taxes and administrative expenses are firm's cost of capital. So return on investment, we know actually, no, this is not it's actually weighted average cost of capital. But roughly they are equating that weighted average cost of capital to ROI adjusted for taxes and administrative expenses. The risk levels of capital components are different, of course, and I already talked about this. Cost of equity is the highest, right? And then second one is cost of preferred stock, and the smallest one is the cost of debt, because cost of capital are proportionate, are commensurate with their risk. Common stock has the highest risk, of course. Common stock has the highest risk. Preferred stock has second highest risk, higher than debt. Debt is the safest, so it can give you lowest return. So a firm's cost of capital is the weighted average of these costs of three capital components, where the weights reflect the dollar amounts of each component in use. So the weights are here. In this case, the weight of the debt is 30%, weight of preferred stock is 10%, weight of equity is 60%. Okay, so let me just give you a quick, because next Saturday it's Thanksgiving weekend, so we won't meet next Saturday. So I better do this example now. So calculate the weighted average cost of capital for Zodiac Company given the following information about its capital structure. It's not different. Cost, debt, preferred stock, common stock. The amount of debt, of course, if you add them up, is 200,000, right? Debt 60K, preferred stock 50K, common stock 90K. Their proportions will be 30%, 20. The weight or proportion will be 30, 25, 45. Because think about it, 60 out of 200, 50 out of 200, 90 out of 200, right? So that will be 30, 25, 45. And their cost of capital, they just gave it to us without calculating. So it's weighted average. So you weight them. This times this, this times this, this times this. So the products are this times this is this, this times this is this, this times this is this. So sum of all of them, that's weighted average. That's weighted average. So weighted average cost of capital is easy, as long as you have dollar value of all the debts and cost of capital given. But in reality, cost of capital is not given. You'll need to find it. You'll need to calculate it, right? Weights are relatively easy to calculate, but if this is the current capital composition, but as time goes on, this will change. So it's going to be a complicated issue, because valuation of debt, valuation of capital components will be different, right? As of time zero, it was like this, but the valuation will change. Time 1, time 2, time 3, the valuation will change, and then the weights will change, and you should be able to predict how the valuation will change, and that's what makes this problem quite interesting. Alrighty, I guess that's all the time we have. Okay, that's all the time we have for today. So we're gonna so we'll call it a day here. We'll call it a day, and I think the exam quiz 2 has started yesterday, right? So I just wish everyone good luck. Have a great afternoon, great weekend, and I will see you after Thanksgiving.
Likewise.
Happy Thanksgiving.
All right. Have a good
All
one.
right,
Thank you,
you too.
Professor.
All righty.
Have a good
Take care,
holiday.
everyone. All right, you
Yeah.
too. You too. All righty, I'll stop sharing, stop recording, and